Hello and welcome to my take on your Daily 5 for the 10th of September. My name is Julius de Kempenaer and I'm your host for today's show. For those of you who don't know me, I'm a senior analyst here at StockCharts.com and the creator of relative rotation graphs, or RRGs as they are commonly referred to. You can find my contributions in the RRG blog on the site, and when you would like to be kept in the loop on everything that has to do with sector rotation and relative strength, please do not forget to subscribe. Every Tuesday I host Sector Spotlight, the show here on StockCharts TV from 10:30 to 11 a.m. Eastern. Again, if anything related to sector rotation and relative strength has your interest, please tune in or watch the replays on the StockCharts YouTube channel. I do like the interaction with the viewers, so if you have anything to say, please put them in the comments below and I will put my answers there as well. But for now, let's do what we are here for, and that is go over 5 interesting charts that have my interest nowadays. I do a lot of work on intermarket analysis, looking at various asset classes. And we can certainly do that on an RRG. And obviously the most important relationship, or maybe the most watched one, is the one between stocks and bonds. And I've narrowed that RRG that you see on the screen right now down to SPY and IEF. So SPY for stocks and IEF, the 7 to 10 year Treasury bond ETF for the bond part. With markets flying left and right, going up and down percentages a day, it's sometimes difficult to keep an eye on what's going on and get rid of all the noise. And taking a step back and looking at a little bit longer term perspective and longer term charts usually helps. At least it helps me. And what I see on this RRG here is quite clear that the preference is still for stocks. SPY is still moving to the right inside the leading quadrant, and IEF is moving to the left inside the lagging quadrant. This is a pretty clear picture telling us that stocks are still to be preferred over bonds. When that will turn, that's hard to say, but these things don't turn overnight. So for the time being, my premise, my base starting point is that stocks are still doing better. And I know that there is a lot of narrative out there and a lot of people who want to call the next top. But this RRG doesn't show a real top, at least not in terms of relative strength. Let's have a look at the price chart of those two items, and this one here is SPY. Please note that I'm using the unadjusted version, which has an underscore in front of it. I feel that it is better for marking support and resistance levels, and that's why I use these unadjusted for these longer term pictures to not get maybe confused or get these levels at different price levels. And what we see here is that the SPY has taken out its previous highs and it's still above those levels. And the decline was vicious last week, but it didn't completely break the pattern. As a matter of fact, the series of higher highs and higher lows is still fully intact, so there's no problem there, just like there is no problem on that RRG that I just showed you. So as long as we remain 40 in or above this area here, which is something like 333 and 340, I think that we're still good on the stock market. We could even go to levels like 320. That's the previous high in this rally, and then even then the rhythm of higher highs and higher lows is still intact. The image for bonds I have chosen IEF is slightly different. I mean, we've got this very nice rhythm of higher highs, higher lows, but the last rally, which was in tandem with stocks, didn't manage to break above these previous highs, and we stalled, and it's getting more and more difficult to actually to break above that resistance level that is now building up. As a matter of fact, if we break below 119, I think there is a double top in place in IEF, and that would mean rising rates. That would mean, because then the prices of bonds go down, which means that the yields are going up. So that's something that I'm keeping an eye on, and that basically enforces the idea that stocks are doing better than bonds. Now, one of the things that I look at a lot in terms of intermarket analysis and looking at the big picture is the yield curve. And StockCharts has a great tool, dynamic yield curve tool, which is, I think, underestimated and undervalued. And I brought it up here as I wanted to show you, a little bit out of the box charts. And what you see here is I've put it back to November 2019. So this is the yield curve as it was in November. And then if we scroll forward, you can see how the yield curve has changed, because this is rather flattish. There's not a big difference between the beginning and the end. And then we go into the decline, and you see that all of a sudden that short end drops, and it's becoming more steeper. So this is known as the steepening of the yield curve, and you can see that process is still ongoing. And there we go, and then this is where we are now. So you see that curve, the whole curve came down, but it became steeper. So yields went down, and the curve became steeper. And I have put that relationship on top of the S&P 500. And this is the relationship between 10 and 2-year maturities. That's the little gray line. And the blue line is the 12-month moving average. The red line is 0. So when that gray line drops below that dotted red line, the yield curve is what we call inverted. And when it goes up, it's steepening. When it goes down, it's flattening. And then when you quickly go over these, it's not a very precise, but it's very roughly, you can see that. Every time when that yield curve dips and becomes slightly inverted or close to it, we are in for some sort of a decline. And then when it starts to steepen, the market rallies. And you see that almost every time. You see that it dips, we got this pretty big decline, and it goes a little bit longer. And then in the rally, the yield curve continues to steepen. You see it here again, and this is where we are right now. So we had that very short inversion of the yield curve last year. Obviously, we had the drop, as we all know it, and we're now in a phase where it looks as if the yield curve is steepening again. So, with all these negative narratives out there and potential stock market tops, and yes, they are all very valid, I would like to make this point as a potential bullish outlook, a bullish narrative. That's certainly a possibility in today's market. And to wrap it up, I looked at and this is where you can see how that yield curve interacts with the various phases of the economy. It's normal to steep. Interest rates are falling or bottoming out. That's what we see there as well. And this image you can see under the perf charts. And the last chart that I want to share with you is the RRG that shows you the growth, value, and size indexes. And this one is a little bit scattered. It's not very clear, but when I change it to daily, this one actually caught my eye, because this is what's happening over the last few days with the market rotation that was going on. And what you can see super clearly here is that people are moving out of large cap stocks, they're moving out of large cap growth stocks, and they're moving pretty much in everything else. So this is small cap, mid caps, mid cap value, small cap growth, mid cap growth, everything else. So it looks as if the market is punishing those mega cap, large cap stocks, and money is moving into pretty much all other segments of the market. This is a little bit shorter term, but the good news is that it looks as if that market rally is getting a broader participation, which I think is a good thing. So that's what I wanted to share with you today, just as a different sound maybe. So it concludes your Daily 5, and I would like to thank you again for watching. I hope you enjoyed the presentation. If you did, you know what to do. For now, stay safe and be careful with your investments, and I see you soon.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.